do if you want, because everyone's here.
Yeah. All right, where's my agenda? We're gonna do the pledge again?
Yes.
Pledge
allegiance to the flag of the United States of America and to the republic for which it stands, one nation under God, indivisible, with liberty and justice for all.
Alright, so we got new agendas for this part of the meeting, and we'll take public participation on the agenda item. Everybody jump. Going once. Come on, Doug, you're the one that does that, right?
They might have questions after we get through this, not until then.
Alright, in that case, we're moving on to, item number 1, the presentation of the 2017 audit. And we'll introduce Gary Kissinger.
Thank you, I appreciate it. Gary Kissinger with Palermo Kissinger and Associates. My firm was engaged to do the 2017 audit of Donegal Township, and we have a couple documents available to review in draft form. The proper process is to review this in draft form, and then we issue the final audit report, and in conjunction with that, there's a filing with the DCT that isn't the same information, but just in their format that gets submitted, and then the audit at that point gets advertised and at the conclusion of the process. But if we could jump into the financial statements, which is the larger of the two documents, and take a look at behind the index is our independent auditor's report. And just to point out a couple of things. Our primary responsibility, this is a financial audit, is to provide an opinion on your financial statements. And the way we do that is we start with the starting books, which is the QuickBooks, your accounting software, and gather that information, conduct our audit in accordance with generally accepted auditing standards, and gather enough evidence to allow us to provide an opinion on your financial statements. So the auditor's responsibility section of that report, the last sentence there states that we believe that the audit evidence we've obtained is sufficient and appropriate to provide a basis for audit opinion. So we conduct our test, do our procedures in accordance with auditing standards, and that gives us enough information to provide an opinion. And then on the next page is the opinion, and it states, in our opinion, the financial statements referred to above present fairly in all material respects the respect to modified cash basis financial position and government activities, business activities, and major funds of Donegal Township as of December 31st, 17, and the changes in its modified cash basis financial position and cash flows for the period then ending. And so a couple of things to point out. That's a clean, unmodified opinion on the financial statements. The key words there, present fairly. So our opinion is, given an opinion whether or not these set of financial statements fairly present the financial position of Donegal Township at the end of December of 2017. And you see a couple of references to modified cash basis of accounting. And basically, that's the basis of accounting that the township has been utilizing the last several years. And it's acceptable to utilize cash basis of accounting for your governmental activities. Basically, you recognize the revenues when the revenues are collected and expenses when the expenses are incurred. Although your business type activities have to use what's called an accrual basis of accounting because it's more accurate when you recognize the receivables and the payables. And your business activities represent your sewage and water fund. So, you know, and from that standpoint, when we look at these financial statements, there's a set of financial statements that are the government activities, and they're on a cash basis, and then the business activities are on an accrual basis. And like I said, the sewage and water funds, primarily the difference between that is you have receivables for unpaid customer bills, and you have payables owed to different vendors that are being recognized, and we'll go over that in a minute. So that's explaining the basis of accounting. And then also related to these financial statements, there are some supplemental schedules that are being presented, and basically this is saying that they're also presented fairly in all material respects. So we'll point that out in a moment. But if you flip behind that, just to give you an idea, you'll have like Roman numeral 3 through Roman numeral 6. that's kind of just like a recap of the activity. But the actual financial statements start behind that on page 1. But looking at Roman numeral 3, you'll see in the middle of the page financial highlights. So there's really 3 things to point out from a highlight standpoint, just to highlight what the bottom line was for last year. The general fund had a decrease in its fund balance of about $297,000. So it decreased close to $300,000 in 2017. State Liquid Fuels Fund increased by about $24,000, and we'll point that out in a few minutes. And then the sewage system fund, the water and sewage fund, had an increase of about $47,000 in 2017. So if you jump the page through the Roman numeral pages and then jump to pages 1 and 2, actually if you jump to page 2, and on the bottom of page 2, turn it sideways, you'll see net position. So your net position of the township at the beginning of 2017 was $1,199,973. At the end of the year was $973,000. So your total net position decreased by $226,000. And if you see the 2 columns to the left of that, the column directly to the left of that is the business type activities. That's that $47,000 increase in the water and sewage fund. So your position increased by $47,000 from the business type activities. But then next to that, you'll see governmental activities, a negative $273,000. That's a combination of your general fund and your state liquid fuels fund, decreased by about $273,000. So we'll go over and talk about the factors that came into play of that. But number one of which was there were a lot of capital expenditures that occurred in 2017 and one-time expenditures. And you build up resources, and at certain times you utilize those resources. So it's not as if you look at any given year and say, okay, well, we need to have a break even in each year, or we need to make so much. In some respects, especially given the fact you have some funding through the Act 13, that you build up those resources, and then decisions are made by the board whether to utilize those resources this year or push them through next year. But so your total financial position, if you look back on page 1, your cash and cash equivalents under governmental activities were $632,494. And on the liability side, you had about $110,000 of money that was set aside that's a liability for escrow deposits. So that's money, there's a separate bank account that money's in the bank. And at that given point in time of 12/31/17, there's $110,000 in the bank, and there's $110,000 of a liability owed to various contractors for road bonds and such things of that nature that were being held. So the net difference between the $632,000 in cash in the bank and the $110,000 liabilities represents your net position from the governmental fund activity, and it was $522,000. Of that $522,000, $44,000 of it was restricted for road projects. That's the number that was being held in the state liquid fuels fund at the end of 2017. The other $478,000 is undesignated. Basically, that's the general fund, capital reserve fund, and your Act 13 fund. So to give you a better idea of that, if you turn 2 pages back to page 3, you can see the general fund had in the bank about $474,000 at the end of 2017. The state liquid fuels fund had $44,000, and the other major funds had $114,000. The other $114,000 represented $110,000 in escrow, and the Parks and Recreation fund had about $4,700. So $632,000. By way of comparison, at the end of 12/31/16, in the general fund, there was about $771,000 in the bank. And the state liquid fuels fund about $19,000, and the other major funds about $98,000. So your total general fund went down by about $297,000. And if you flip to the next page, you'll see that number on the bottom of page 4. So page 4 is kind of the recap of everything in each of the funds. The first column is the general fund. At the bottom of the page, you'll see at the beginning of the year, there was $771,000 at the beginning of the year, $473,000 at the end of the year. So it's a decrease of about $298,000. So up above, but on the top part of the page are your revenues for the year. So Your total revenues in 2017 in the general fund was about $1.2 million, $1,185,000. Your total revenues in 2016 was about $1.3 million. So they went down by about $100,000. Just give you a recap of what that $100,000 represented. About $53,000 less in taxes were collected in 2017 versus 18. I'm sorry, 17 versus 16. And the main difference of that were transfer taxes. So the real estate taxes and the earned income taxes, they were very consistent in collections. You received almost the exact amount of real estate taxes in 2017 and 16, which is makes sense. Even though you had the reassessments occur, you might have received maybe about $1,000 less. Some of that had to do with just the reassessments and some of the bills maybe, but that was pretty much a net difference of zero. Earned income, you actually collected about $10,000 more of earned income in 2017 versus 16, so it's good to have a trend that's at least going up a little bit. But the transfer taxes make up the difference, the reason the total taxes went down by about $53,000, and that's out of your control. In 2016, there was a large transfer of a property that was sold of about $40-some thousand of transfer fee that you received in February of 2016, and usually it's tough to budget that number because it's inconsistent. But the other factors that for your revenues to go down, even things like some of the fees you collected, for instance, the trailer fees that you collect were less in 2017 versus 16, and once again, that's the type of revenue that's kind of outside of your control, and but there was a decrease of that amount. And your impact fee money went down about $24,000. So the Act 13 total was $364,000 in 2017. It was $388,000 in 2016. So went down about $24,000. So those differences kind of make up that $100,000 less of revenue. But that's not a significant difference, but it's explainable. There are reasons why it went down. On the expenditure side, 2017 expenditures on the general fund, $1,483,000. For 2016, that number was $1,113,000. So your expenses went up by $370,000. So there were about 9 or 10 significant items that were purchased in 2017 that kind of account for that difference. $30,000 for gym floor repairs, $70,000 more in volunteer fire department contributions than in the previous year. You had a $36,000 payment to the West Alexander Fair for restrooms. There was a dump truck for $85,000 that was purchased in 2017. Road department truck for about $36,000. Police vehicle about $32,000. A mower for the road crew, another $11,000. And so all those items accumulate to the difference of about $370,000. Now, the bulk of that money was spent out of the LSA funds, the Act 13 funds. So at the beginning of the year, we had talked about that Act 13 fund having about $587,000. At the end of the year, it had $408,000, and that's built into this $473,000 number on page 3. So your cash at the end of December of 17 of $473,000. There were really 3 accounts that make up that in the general fund. There was the general checking account, which had about $44,000 in the bank. The capital reserve fund had about $21,000, and the Act 13 had about $408,000. So, that capital reserve account, that's a large sum of money that gets deposited into that annually. Although it did go down by $24,000 in 17 versus 16. But looking back 2 years, at the beginning of 16, you had about $350,000 in that account. It built up to $587 because you didn't use a whole lot of those of that money, of that funding. You only used about a third of that funding maybe in 2016. So it built up to $587,000 at the end of 16, and then you utilized $544,000 of it during 2017 to drop it down to the $407,000. So that's an example where when you take a look at your bottom line, it's just a lot of times it's planned expenditures that the board approves capital expenditures and utilizes that money in a certain manner, but it does impact your bottom line, and you have to be aware of the fact that how low that fund gets and where you stand at the end of 2017. You had a general fund balance of $473,000. So typically you like to have about 25% of a fund balance, so it's 25% of your budget as a fund balance. You know, when that calculation was done in the previous year, it might have been about 43%. Now it's about 28%. So you're getting close to that 25%. The only reason I use 25%, it's just a rule of thumb. There's not a requirement. But, you know, that represents a quarter of your budget, you know. So if you want to, in a perfect world, you get your revenue in a consistent manner throughout each of the calendar year, and you get your expenses in a pretty equal manner throughout the year. But that doesn't necessarily occur, especially in municipalities. The first quarter is kind of a dry period where you don't have a whole lot of revenue coming in until the real estate tax starts kicking in and the earned income tax. So it's important to have that reserve so there isn't a cash crunch. And, you know, I'm sure in 2018 you felt the effect of beginning the year with less money than you had in previous years. So it's important from a budgeting standpoint to keep an eye on that.
Eric, a question. Up above it says intergovernmental revenues and charges for services. What does that mean?
Intergovernmental revenues.
It's on that page we're on right now, page 4.
Yeah, $452,000. Those are all the government grants that the municipality would get.
Is that the Act 13 also, or no? It
It's
shouldn't be.
yeah, it includes the Act 13.
Okay.
It also includes, right next to it, you see the 215 is a statement for fuels, but it also includes a fire relief revenue that's received, because that's a pass-through. It comes in as revenue, goes out. It also represents the gambling money that's received. I forget what they call that, but there's an annual allocation that each municipality gets.
Is the police protection contract included in that as well?
There's a state liquid fuels.
No, I'm talking about the
No,
money,
that-
the money that the township charges the other municipalities where we
That's in charge.
provide.
That's in charges for services.
Okay.
Two lines for.
So that's what I was talking, okay, that's what that is.
Yeah.
Okay.
Yeah. So of that 121,000 for charges for services, last year that number was 117,000, so it went up by about $4,000. But the bulk of that intergovernmental revenue number is the Act 13 funding. So, bottom line on page 4, just to explain, summarize the decrease of $273,000, it's really all those capital expenditures that occurred in 2017. And if you look on the next page, on page 5, this is where the budget to actual is presented. And a couple things to note here, under total actual revenues of $1.4 million versus the budgeted revenues, so you see a variance of about $284,000. Of that, almost all of that is up in the intergovernmental revenue category. And the reason that is you had only budgeted $100,000 for the Act 13 money. And you realized $364,000. So there's a difference of $264,000 in that one line item, which makes up pretty much all of it. Otherwise, like if you had budgeted $364,000 of Act 13 money, you'd have a variance of about $20,000 budget to actual. And on the expenditure side, you know, the budget for 2017 was basically utilizing, there's a deficit, it was showing a deficit utilizing, not a deficit overall, but a deficit using current year revenue versus expenses of $660,000. So it was planned that you would utilize those capital expenses, although I have to say, if you had spent as much of the money that you had budgeted, you would have ended up with $135,000 at the end of 12/30/17 versus $522,000, and then you really would have felt more of a cash crunch. You know, yeah, and the bulk of that, you would have had to use that, pretty much spend down all of your Act 13 money, but you still had a reasonable amount of Act 13 money in the bank at the end of 2017. If you look on the next page, you'll see the proprietary fund. This is basically the water and sewer fund. So these next 3 pages all just represent the water and sewage fund activity. And you had cash in the bank of about $63,000 versus about $68,000 the year before. You had receivables, accounts receivables of about $80,000, so that's net of in $70,000 the year before, so that's about a $10,000 increase. So overall, your total current assets increased by about $4,000. On the next category is your capital assets. So this is basically all the equipment in the sewage and water lines. It has a value of $1.5 million, which is basically historical cost. All we do is depreciate that over, a 40-year life or a 50-year life, and we have a little bit of depreciation on that number. But on the liability side, there's a couple key things to point out. You have total liabilities of about $1.2 million, and you'll see under the current liability, there's a current liability, current portion of long-term debt, and then there's a long-term debt less than the current portion. So the combination of those two numbers, the $83,000 and the $1,096,000, is close to $1,179,000. And there are 3 loans that are outstanding with the water and sewage fund. If you look back on page 21 and 22, so on page 21, on the page, you'll see there's 3 loans outstanding at the end of December. One's with Penvest. It had an outstanding balance of $806,000. You were making $4,301 a month, and its final payments due in December of 2034. The second loan is you have a loan that was the debt taken over from the West Alexander Borough Municipal Authority. And I think it's Berkedia, how do you say that? Berkedia Capital. And you're making semi-annual payments of $9,300. It has an outstanding balance of $66,000, and you're going to continue to make those payments until August of 2021. And the last one is with Community Bank, and it has an outstanding balance of $307,000. You're paying about $2,700 a month, and that's paid off in December of 2028. So the combination of those 3, if you look on the top of page 22, is about $1,180,000. Of that, about $83,000 of principal will be paid in 2018, another $20,000 of interest. So total debt service of about $103,000 in the next several years, and then it kind of goes on from there. And like I said, the latest that gets paid off is 2034. So that's your debt schedule. The general fund, the governmental funds, doesn't have any long-term debt, but you did have a couple capital leases that you paid off in full in 2017. But at this given point in time, this is the only long-term debt that the township has. But if you look back on page 6, so that's included in the total liabilities, that $1,180,000. And you also have some accounts payable, just timing differences, some of the bills that get paid to the city of Wheeling for water and things of that nature. And so your net position is your difference between your assets and your liabilities. So for the water and sewage fund, your net position is about $452,000. Of that, a good bit of that is tied up in your fixed assets. So this $325,000 number invested in capital net of related debt is basically taking the $1.5 million of capital assets and backing off those 3 long-term debts that I reviewed. And you'll get back to this $325,000 number. And the reason we break that out is because obviously you can't convert those water and sewage lines to cash. It's an asset, but it's nothing that you can utilize for future operations. But this next number down, the unrestricted number of $126,000, that's basically the liquid funds that you have available to operate the water and sewage fund. And so that $125,971, that grew by about $6,000 this past year. So that's a reasonable amount of net resources in that fund that would permit you to continue to bill and collect those billings, and then turn around and pay your long-term debt and pay your expenses. So if you look on the next page under the water and sewage fund, you'll see total revenues of about $426,000. So Included in that total revenues number, there's an insurance proceeds of about $11,000. I guess there was some water damage that occurred in the 2017. You received some insurance proceeds of about $11,000 against that. So, but the other sources of revenue, the water revenue and the sewage revenue, combined, that's a total of about $430,000, which compared to the previous year is a little bit more than the previous year, but mainly that was attributed to tap-in fees. You had a little bit more revenue last year, but you had more tap-in fees in 2016. But overall, the revenue stayed pretty consistent. On the operating expense side, you can see we break out the expenses for the sewage service and the water service. Total sewage service is about $152,000, but of that number, you'll see a couple lines up above it, you'll have depreciation of $21,000, $22,000. That's a non-cash expense. That's just taking the cost of that and writing that off over the period of the useful life. So net of that, you had about $130,000 of expenses, and that's about $13,000 more of expenses in 17 than you had in 16. And then when you look at the water service, you had about $205,000, but if you back off the depreciation on that, you had about $187,000 of expenses. Last year, you had about $172,000, so about $16,000 more expenses in 17 than 16. So combined, you had about $30,000 more of operating expenses that occurred in 2017 versus 16. The main factor of that was you paid about $40,000 of cost to identify the leak that was occurring. So that was a one-time cost that happened in 17. It kind of accounts for the variation, the variance between the 2016 cost versus the 17 cost. So the net difference of that is $47,000. So your position increased by from $405,000 to $452,000. And then jump back a couple pages to the page 9. That's the fiduciary funds. Pages 9 and 10 are the fiduciary funds. It's basically your pension funds. So, you know, pensions, we have 3 pension funds, but one of the 3 is with the union. So in the name of the township, there's just both the police pension plan and the non-uniform plan. So the combination of those 2 plans had about $487,000 of assets. And there's footnotes, and they're much too long to even go through, but there's just some required disclosures. And basically, you get a pension evaluation done every 2 years. And the latest valuation was done at December 31st, 16, so you'll have another one that's 12/31/18, and that information will be presented. But so when you look at the information back in the financial statements related to the pension, it's really like a 1.5 year old information, because that's the most recent pension valuation that's occurred 12/31/16. But you have the other 2 plans. If you look on page 31, the police plan it was a percentage of funding versus liabilities. So you have a total accrual, actuarial value of assets of $571,000. The actuarial liability is about $396,000. So you have excess assets over liabilities of about $175,000 in that plan. So that plan is fully funded, and to the tune of a ratio of 144%. The other plan is
it defined benefit?
Both those plans are defined benefit plans. Yeah. So on page 25 of the non-uniform plan, kind of the same scenario, the same calculation. You had actuarial assets of $134,000. You had actuarial liabilities of $180,000. So that plan had a deficit of about a deficit of assets over liabilities of about $46,000. So it's only been about 75% funded. So that's why, part of the contributions that go into the non-uniform plan, your state aid can go in there to help fund those contributions, as well as your state aid is being used to make the contributions to the union plan as well. So thought I'd just point that out. So other than that, the financial statements, there's a lot of detail in the notes. Most of it relates to the pension plan. I did point out a couple things related to the long-term debt on pages 21 and 22. And a couple other things to point out, at the end of the report on page 34, you did have, we talked about the escrow liability of $110,000, so that's being tracked and that's shown as a liability, as well as pointing out the fact that you had Act 13 impact distributions of $364,000 last year. So in addition to the financial statements, we have the second document, which we call management letter, and it's just our opportunity to communicate a few things to the board. And the first thing is the budget versus actual results. Just keeping in mind that you had, based on that page I pointed out, what was the budget to actual, for 17, the budget actually showed a deficit, an operating deficit of about $660,000. That actual decrease, the actual decrease in fund balance was $273. So you didn't use as many expenditures or as much of the fund balance as you had budgeted for, but it really should be a process where you recognize your revenues in the budget based on what you feel the net realizable value of those revenues should be, and the expenses should go based on what you're going to use. It seemed like maybe the budget for 2017 just utilized the revenue side was very conservative, like I said, particularly on the impact fund, because you had historically received $300,000, $400,000 of impact money, but only $100,000 was budgeted. And then on the expense side, it was including a lot of expenses that maybe just didn't come to fruition in 2017, but had they come to fruition, you would have been a lot tighter than you would have been at the end of 2017. And so I'm saying approximately 180,000 of that decrease is attributed to the Act 13 impact fund. And during 2017, the township utilized the Act 13 funds for capital projects such as roof replacements, building renovations, police vehicles, road vehicles, contributions to fire departments, and some of the detail that I went over before. On the next page, and this is a comment I noticed that the prior auditor had a similar comment, that your water and sewage fund, the proper way to report that is on an accrual basis. So we had to make the adjustments that were necessary to recognize there was the accounts receivable and payables at the end of the year. You get reports